Welcome to Nexgen Software. My name is John Novak, the CEO and developer of the software. In this video, we're going to go through trend trades. We're going to talk about how to make money as quickly as possible. When we talk about making money, very important you start with a simulator. Do not trade live money until you understand all of the rules perfectly. Write out your rules so you understand them. Document your trades and pictures in class. Start on a simulator and trade until not only you're confident, but you're confident that you're doing the right trades and the correct money management. When you do start trading live money, start very small, $400, $800, something really small. If you can't make money on micro, teeny tiny contracts, you'll never make money on big contracts. So because of the leverage involved, you're going to be able to take a very small account when you trade very consistently and turn it into a huge account. And that's really our goal for you. All of the education that you're going to need is on our educational page on our website. You're going to be able to download and read through the trading plan, software user guide, and then long videos that go into a lot of very detailed explanation. The video you're watching now is going to be a very short video. On page 2 of the trading plan, you're going to be able to click for how much money is required to trade any contract you want to trade. Our objective is to get you making $400 a day or more per contract. General losses average about $100 on losing trades. You're going to be able to track your trades in a spreadsheet, which you can get from page 2 of the plan, and you'll know when market reports are going to come out as well. Our rules for day trading the trend are very simple. You're going to make sure that the trigger lines are the same going up or down on both charts. You're going to make sure that you haven't hit a termination condition, and you're going to make sure that you have room to your target, and then you're going to buy or sell a pullback at the trigger lines that support a resistance. Let's go through really quickly and talk about the trigger lines that you have to have in order to do a long trade. You must have the small triggers up and above the large triggers on your 14-2 chart. This is the only look in which you can do a long trade. You must have both triggers going down and the small triggers below the large triggers on the large chart, or you cannot do a trade. When the triggers come together, you're going to really not do any more trades at all. Now, just to give you a second example of this, and again, we're talking about using your 14-2 chart. 100% of your trades must have this trigger line configuration in the beginning. Not saying that there's not other trades that you'll take later once you get more educated. This look right here is your guaranteed money, guaranteed look. You're going to lose some trades every once in a while, but more often than not, you're going to end up winning your trades with this look. The same is true to the downside. Again, I'm really pounding this home because you have to get this down first. 14-2 chart, you must have the small triggers down. They must be below the large triggers, and you're going to find the opportunities at Fibonacci to sell and make money to the short side. Once you get going, you're going to see two things happen. You're going to be in a situation where it's okay to take long trades if you have areas on your charts, and it's going to eventually have the triggers inside. Now we use a couple terminology really for this. A couple terms, we call them weak, but they're not always weak, but they're inside of each other, really is what we're trying to say. So if the small triggers are physically in between these two large, that's your warning. Stop, stop, stop. Okay? Now, same is true in reverse. If the market's going down and the small triggers are below the large triggers, you can sell pullbacks, and then when they come together, you better stop. And if it goes the other way and they're both crossed up, you can now take long trades. You're going to see another situation where you're going to do 1 or 2 long trades because the small triggers are above the large triggers, and you're going to ask the question whether or not you can keep going long if one of the 2 triggers is outside. The answer is yes, as long as you have appropriate Fibonacci areas from which to trade. Again, without repeating myself for the 32nd time, stop going long when the small triggers are in between the large triggers. If they turn and cross the other way, you can look for short trades. Now, how do I get into a trade? If the market's going down, it has to literally be this obvious. Small triggers below the large triggers on your 14-2 chart. Small triggers below the large triggers on your 5-1 chart. This is the moment in time on the right edge of the chart when the market's on the low that you will take a trade. Your entry area is going to be whatever resistance, mid-band, 1-to-1 dots, or fibs that is in between the triggers. So what you're going to do is you're going to literally place your mouse right here, right click on the chart, and you're going to place a limit order to sell the market at that price. That's it. That's as easy as it gets. When the market gets there, you'll be filled as the market's going up. If the market continues to the downside, which you can see clearly it did because of our overwhelmingly strong triggers, you will then reduce your 3-point risk to a risk that will be above the down bars. So you're getting in on the way up. You're pulling your stop down as the market starts to trade back in the trend direction with the triggers on the 14-2 chart. You're going to see the exact same thing in reverse. If the market's going up, meaning that small triggers are above the large triggers, and the small triggers are above the large triggers, you're going to buy blue fibs and green support lines in an effort to take it up to and to trade up to Fibonacci resistance. Now, we don't wait for resistance to hold. We place a limit order at resistance, so when it reaches it, we're already exiting our position without having to think about it. Now, I did pull up two of our older pictures. It says the exact same thing. 14-2, 8-2 chart triggers, which are now superimposed on a 5-1 chart. So both chart triggers are great. At the time of the first bar down, you're going to look inside of your trigger lines. You're going to place a limit order to buy inside of the trigger lines at support. So hopefully when it gets down there, you'll have your entry. Now, same thing. This is the older chart, but it's the exact same logic. If the 14-2, 8-2 chart triggers, which are the triggers on your 5-1 chart now, are right, when you start to make a retracement to the upside, you're going to sell in between the triggers at resistance, 1-to-1s, mid-bands, or fibs, depending on what's in there. That's it. That's all there is to the trade. So strong large triggers, strong 5-1 triggers, buy or sell a pullback. We're going to take a look at the things that you're going to have to spend a lot more time with. Management of trades. This is an older picture when we used 3 charts. And the thing that we used the 8-2 chart for was to use our trigger lines to help us to determine the strength of the large and small chart so we knew when to hang on for more profit. Now in our current configuration, we have superimposed the 8-2 small and large triggers on our 5-1 chart. So we've eliminated the need for 3 charts, which makes things a lot cleaner and easier for people. So when you're getting long and you're going to stay in your position, as long as the small triggers remain outside, the large triggers on both your 5-1 chart and your 14-2 chart, you're going to hang on for more profit until you get up to some type of a resistance or the conditions change. And again, a lot of you are going to say, well, what about divergences, right? Because divergences have a tendency to scare, these little negative numbers scare new traders. So here's a simple rule for you. It's acceptable to stay in a trade if both triggers, large and small, remain crossed up and the small triggers are physically above the large triggers. You're going to get divergence, but it's not going to stop the market because of the overwhelming strength of the triggers until you get up to your target. I'll show you the same thing in reverse. If you have divergences, don't worry about it if the small triggers are strong down and they're physically below the large triggers. So you're going to have the short trade was way over here. But you're going to make it all the way down to a target, and then eventually, look, the small triggers and the large triggers have lost their strength, and the smalls crossed above the large. That's what changes the color. Now divergences are going to be very powerful, and you'll notice the market did indeed reverse. Another time when you're going to pay very close attention to divergence. If you reach Fibonacci resistance and you have divergence, especially if the trigger lines don't break above resistance, you're going to stop going long, period, or exit any type of position. If you reach Fibonacci support and you have divergence, this little negative number, especially if the trigger lines do not break the support, the market is probably going to reverse. So these are two conditions in when you would stop taking any type of trend trade whatsoever. Now, a little wrinkle on that, because you're going to see a blue Fibonacci support and a divergence, and you're going to say to yourself, well, I should stop. But remember what we said about the trigger lines. If the trigger lines are below a Fibonacci support, the likelihood is that the support is going to break. And since they're both crossed down, you can actually do a trade, even though there's divergence on the low. It doesn't matter. It's not going to hold because of what the trigger lines say. So it's almost as if this divergence doesn't exist with two down triggers and the small triggers below the fib and below the large trigger. You're going to go short, you're going to hang on, you're going to go short again, and then eventually you're going to reach Fibonacci support. Notice the location of the triggers does not break below support, and that doesn't count one little tick or two. I mean, they have to be well beyond. And the fact that you also get divergence from support tells you that you're done going short in this instance. Here's another example of the same thing. When you get divergence from Fibonacci resistance, we're not going to do any more long trades. We're also not going to do any more short trades when one of the triggers is crossed up, right? So we're not really doing any trades, trend trades, until both triggers cross down. What we're waiting for is we're waiting for this resistance with divergence to actually break and turn blue. And this is very simple. Only when the red Fibonacci turns blue is it broken. So if the triggers are up and the fib is blue, we're trying to take an attempt to buy the market on the breakout to get up to this next area. Everything that you do is predicated on Fibonacci and trigger line looks, reads, and colors. Now there's one little exception to that, which you'll see, which is our trade number 2 that's in our plan. But again, look, you get to the edge of Fibonacci resistance and it's red. Sometimes, the synthetic fibs, which come from different time frames, so this is a 5-1 chart, sometimes they come from the 14-2 or the 21-3 chart, they'll turn blue. And they turn blue because the small triggers got above them. But if the last Fibonacci on your chart remains red, then this is still resistance. Even though these are blue, you really ignore these blue ones. Think of this as a Fibonacci resistance window. And as long as the last one remains red and then you get divergence, this is an opportunity where the triggers cross at the top, and some of our traders will take an attempt to try to take a short trade. Now, vice versa. Over here on the right, notice that everything broke above. Not only the colors turned blue on the synthetic fibs, but the last red fib actually turned blue. That's your indication that we have made a clean breakout, and we would expect one more trend trade up to the next Fibonacci resistance. So it's very important you stare at the last fib, not some of the first fibs, or you may get tricked into doing trades you don't really want to do. When the last fib changes colors, you know you're home free. Now, I want you to have a thought in your head, because a lot of new traders really worry about whether the fibs are going to hold or not, and it doesn't matter. Because, and again, this is an older chart on a 21-3 chart, but I had this picture for a long time. It came out during the COVID pandemic, but it really illustrates what's more important for you as a new user so you can make money quickly. You're not trying to buy the fib. You're waiting for the fib to hold and then the trigger lines to roll and get really strong and take a couple trades. You're waiting for the fibs to hold, and then, or you're waiting for fibs to break, and then when the triggers are really strong, you're looking for an opportunity. And then when you get to the fibs, you're waiting for the triggers to roll or the fibs to break, so you have another opportunity. And then when you get to the fibs, you're waiting for them to break, or you're waiting for it to roll, and then you get a couple more opportunities. So the fibs really act as places where you stop taking trend trades, or you're really determining a breakout area. So don't think about trading the fibs right away. Think about trading the triggers and the fibs after they've either broken or rolled. And those are going to be the really easy winning trades for you. One of the other things that people will do sometimes is they'll try to be the first one to go long or short. Be very careful in thinking that the market is going to make a bottom unless you make a really strong trigger line push the other way. So sometimes the small triggers will get above the large triggers, but if they're still crossed down, traditionally the market's not going up yet. And you can see they tried to go up, and they tried to go up, and they tried to go up. Actually, we had a big red Fibonacci resistance here, so they kept hitting resistance. But when you add in the support and resistance along with the right trigger line read, you're going to find short trade, short trade, short trade, short trade, short trade, short trade, and then nothing, 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 and then one more short trade. So it's always going to keep you on the right side of the market. Let's take a look at one more little kind of exception. Remember we said if one trigger remains outside of the large triggers, it's not weak, it's still going up. So you're going to see this situation happen sometimes, and you'll see it in some of our videos, where you'll get a couple of divergences and the trigger lines will cross over and the market's going to go down a little bit lower. However, whenever the large triggers remain up on the 5-1 chart, and in conjunction the small triggers remain outside the large triggers on the big chart, most of our experienced traders are buying this Fibonacci support and taking a huge trade, a huge advantage. But the only time you can do that is when the triggers on the 14-2 chart agree. And you'll see that happen from time to time. Just so happens I have another slide of it. Notice where you might do a trend trade long here, maybe even lose. It's okay, that would be the right trade. But what happens is, and again, a strong trend and strong 14-2 triggers and small triggers very much above these triggers tells us that we're going up. So they didn't want to do it from the mid-band, so they ended up doing it from Fibonacci support. And it doesn't look right because this is going down on the small chart. And if you don't take that trade right away, it's okay. You will as time progresses because of these triggers on the bigger chart. However, this is kind of an instance where the small triggers are inside of the large triggers, but they're going up really strong. And you're going to say, John, you told me that I can only do trades when the triggers are outside. And for the most part, that's really true, but there is one exception, and I'm going to show it to you, and you're going to see how easy it is. If there's no divergence on the high pivot before you get a trend trade on your 5-1 chart, you can take a trade if they're running together on the smaller chart. That's it. Really easy, isn't it? So yeah, you may catch the bottom, you may not initially when you're first getting started, but when you get trade number 2 and 3, that's more than your daily goal right there on those two charts. And again, I want you to think about your daily goal. You don't have to catch them all to make your daily goal. If you took this first trade short with resistance and made money, and you took the second trade from the mid band and 1-to-1 short and made money, and you stopped going short because of divergence and fibs, I mean, from 57 all the way down to 47, that's 10 S&P points, which is, well over it's 25% more than your goal. And what happens is, because there's divergence in blue fibs, this next short trade, which you can see clearly would have won on the big chart, becomes very difficult for you to take as a new user. So the ones that we want you to take are the trades where they have all of our triggers going down on both charts, nice and easy. You have Fibonacci resistance or mid bands or 1-to-1s. No divergence ahead of the trade makes it even an easier, better, stronger, faster trade traditionally. And you're going to be able to reach your goals and objectives with just those trades. Take a look at this. Again, very simple. Strong triggers breaking above everything else. The market pulls back to the mid bands and fibs. And this is a situation, when you're trading two contracts and we tell you take 200 on your first one, or 20 if you're trading a micro, and then you trail your stop and you allow the market to work and get to the next area. If the market never gives you a reason to exit, you really want to be long from 34.01 all the way up to 34.10. There's no reason not to take 10 points, especially if your trigger lines and there's nothing in the way to tell you that the market's going to stop. Now, there are times, again, the exit comes from reading your triggers. This is when we had our 8-2 chart, and again, you could still build one and use the template on it. It's not going to hurt you, but it displays the same fibs and it displays the 14-2 trigger, so it's kind of a duplication of what we did. We kind of phased it out, but if you want to run it, it's not going to hurt you. Notice that when we're making decisions, we're going to read where the triggers are in relationship to each other. When they're above and strong and they're above and strong, we're going to ignore anything that tells us to get out because it's lying to us. So we're not going to take an exit just because there's divergence when the triggers are outside of the large triggers. Hopefully that's clear. Now that's opposite when the triggers are getting inside the triggers. So if the small triggers are inside the large triggers, if we're going to take a long trade at support, we have to be ready for divergence to happen, and we have to be ready to exit our position very quickly if it does happen. Because when divergence happens and the triggers are weak, the market really does keep going down no matter how far down you put your stop. So the idea in this situation is to lose a teeny tiny amount, and then obviously the market went down. I wish I would have said this one, because this one actually went all the way up to there. You can take my word for it, or you can go back to that day and look at it. But strong triggers and fibs, it made it to the next resistance, and it was worth a lot of money. Weak triggers and divergence, yes, they do reverse. That's it. That's all you need to know for management. Really simple. Now, there are some absolute termination conditions that we use. If the market hits a bunch of red fibs, especially with yellow dots, we're no longer going to take long trades. So we want to trade to the fibs, but if the fibs don't break and the triggers don't get above it, that's the end of it. If the triggers roll over and we get a short trade and we're trading short, if we get back to a prior divergence line, especially with a fib, we're going to stop going short no matter how strong the trigger lines are. And then if they roll over, we're going to start taking long trades. You're going to see the same thing. You're going to see how easy and the repetition of what we do. Great look with the triggers outside. We're going to look for every long trade we can get our hands on. When we reach fibs, especially if the triggers are inside, we're going to expect that the market's going to go the other way. So we would not only exit our position, but we wouldn't take any more new long positions. So this is kind of a super picture. I mean, this was from the 16th on the micro ES. Look at this. We had every termination condition on the planet. Blue fibs plus yellow dots plus a divergence plus the triggers were above the large triggers. Small triggers above the large triggers. Traditionally, that's where our counter trend traders are going long. Then we had the same thing up at the top. We had red fibs with yellow dots, and that almost always makes the market go the other way, regardless of how strong the triggers are. And maybe one or two trades short, but then very quickly back into fibs, yellow dots, divergence lines. And these things are kind of conditional. I mean, if you have two or three dots and lines all together, it's not going through it. And you have to really demand a very serious breakout. If not, it's going to go the other way. Now, I do say, I call it a conditional termination, if you will, because we had a prior divergence line, but that's all it was. Just this one little line all by itself. So it's kind of naked out there, right? And the triggers were so strong that we had to do a long trade. We actually bought, I think that we did this in class, 3401.50. So because the divergence line was there and because we had divergence on our small chart, we were just expecting a deeper retracement before it went up, which we actually got. So if you got in early, you had to have a little bit of a bigger stop. But then the condition changed. So that same pink line on the large chart actually worked after we had a divergence the second time, and our small triggers were below our large triggers. So that's kind of what I mean when I say conditional termination conditions. Yes, it's a termination condition, but because everything is so strong on both charts initially, we're going to take it anyway. But when the smaller chart weakens, and that's where change starts to happen on the small chart first, then we have to respect that and exit our long position. We did this one in class. I did right, wrong, and right again. So I'm going to show you what we did. We were looking at these yellow dots on the big chart, which we all know is one of our termination conditions. And before we got short, we were talking about in class how there was no divergence whatsoever. So the yellow dots could be a termination condition, but, look what happens. And I did it right, wrong, and right again. So the right trade was to go short at resistance and fibs and mid bands. And the right exit would have been to get out after divergence. Because now that divergence with a weakening trigger tells us that these yellow dots have a better chance of making a bigger bounce. I actually added on showing people that if you had done a trade after divergence on the small chart from the yellow dots on the big chart, you would have lost your trade. And it's not that it won't go down, because if you read your triggers on your big chart along with your fibs at the top, these triggers going down and being below the large triggers tells us that this fib, which was up here, was probably going to hold. So we kind of did one of those exception trades from the edge, but only because these triggers were so far below the large triggers that were going down. So it makes these kind of exception trades really well. I probably could have stayed in that, but again, because the large triggers here weren't crossed down still, I opted to take the exit, but you can see it did break through. So again, keep in mind, you're going to do trades because of the strong triggers on the big chart, period. But you can't see change happening on one bar on a 14-2 chart. All of this happened on one bar on a 14-2 chart. So it's really imperative that you start paying attention to your triggers on the 851 chart, the divergences, and whether you're going to stay in or get out. And then you can see once they start to weaken, sometimes you get one more bounce, but then you have to know when to quit. So all of this literally happened on one bar on the 14-2 chart. So what we tell people is don't get too married to your long trades once the small chart fades out. It's your warning that this one may not go. And if it does, it can go without you. That's okay. Couple more slides and we're done. This is a look we see a lot. Really strong triggers if the large triggers are still above the blue lines. If it's a really good trade setup, we're going to take it. If divergence happens on the small chart or something happens, we're going to get out of that trade very quickly. If this was below and everything was red, it'd be a different story. So again, this is one of those conditional trades. We call it a 50-50. It's really strong down, but 50% of the triggers are above support and 50% are below. Again, another situation where it's imperative that you pay attention to your small chart. Because if anything goes wrong, it goes the other way really quickly. Everybody understand that? Pretty easy. So look, your goal is to make $40 a day on one micro contract. I mean, you're going to find it really easy when you're doing it with the triggers, with the trend. Do it on simulator, post your pictures in class, track your spreadsheet, make sure you can follow the triggers and the rules perfectly before you go live. On page 2 of the plan, we've got this spreadsheet which you can download. Here's a little link for how to download it, how to save it, what do you need to write on your charts, how do you do market replay, how do you clean out your data, how do you capture pictures. Here's a bunch of study pictures that have a lot of really good, some of these are in here, really good thoughts. And again, I just want to leave you with this. Trend trading is going to be the key to you winning money, and winning money very quickly and very confidently. We've refined these trades and these rules over so many years that we're really confident you're going to do really well. High probability, strong trigger lines are going to give you what you need. Don't take trades without the trigger line agreement or when you get to a termination spot. These are going to fail. Know when to stop or skip a trade. And more importantly than anything else, make sure you're doing the correct trades by posting them in class. Get a little feedback for a month or two and make sure you're doing it right before you head out on your own. I appreciate you guys taking the time. Hopefully you see how obvious the good winning trades are going to be. We'll see you guys in class.